Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of LME 3-month copper, aluminium and lead. LME 3-month copper. The V-top over the middle of May drove this market low for bearish halfway hesitation over mid-June, mid-July until mid-August. Down through three important congestion zones which have become important resistances once again. We have overhead 97.50 to 99.95, then congestion between 93.95 to 96.06, and most recently a smaller one between 91.83 to 92.56 that saw the market push up through 2 weeks ago, then got itself capped by the next congestion area, overhead plus the declining green short medium moving average, currently at 93.55. We're way back down below it again today. The capping of the 93.95 to 96.06 area caused the market to not only exit below the next congestion at 91.83 to 92.56, but also to drop below the gold long moving average, currently 91.28, and the 50% Fibonacci line of the July 2022 to May 23 move at 90.29. As you can see, we're in now a fairly free zone from about the 50% Fibonacci line down to the purple highlighted extension to the upper trend line, currently 87.79. This is an interesting support as it was the launch pad for the move up in March this year and the landing pad for the decline in early August, and thus worthy of close attention. We've also drawn an early July to late August bearish Andrews pitchfork to assist in defining the bearish angle of attack. I'm not in love with this pattern. I would in a heartbeat finesse it to a bearish shift pitchfork or retire it completely, but for now I think it will do. LME 3-month aluminium. The move higher over March, April and May, and I suppose even the most recent one from early August, originates back into late February with the market breaking higher from a diamond pattern type formed back then between late October 2023 to late February 2024. Now please remember this is the congestion generated by this diamond pattern on the wide between 2100 to 2400, but really between 2156 to 2297 that caused the very recent rise, though obviously not the pattern itself. Okay, so going now to the peak in late May, the market back then made new recent highs, but at the same time sowed the seeds of its own bullish destruction by having a 2-day pipe top that was also part of a larger 2-week horn top. Prices in essence moved lower with a small halfway hesitation early June and a larger one over mid-May to mid-July until the end of July, when the decline was stopped by the extension to the neckline, currently at 22.25, of the June to July 2023 reverse head and shoulders neckline pattern. From this base, prices started to build again and experiment with moving higher. Thus, we have seen a move higher up until last week from the same price zone as the earlier diamond bottom pattern, roughly between say 2400 to 2100. In the process, over early to middle August, the market constructed a small ascending triangle pattern, reaching the primary and secondary targets on the upside and pushing up through some significant resistances now turned supports, notably the long moving average currently at 23.76, the twin neckline extensions of the October 2022 to May 2023 head and shoulders top, currently at 23.26, and the March to May 2023 head and shoulders top, currently at 23.39. Prices also moved up through the 50% Fibonacci line of December 23 to May 24 move at 24.54 and the short medium moving average currently 24.12 and the medium moving average currently 24.97. However, once prices reach the significant bright red highlighted middle time, currently at 25.35 of the December 23 to July 24 bullish shift pitchfork, well, prices hesitated and pushed back down through all the resistances that had been converted into supports and now back as resistances. We're now punching through on the downside the green short medium moving average currently at 24.12, but there are 3, possibly 5 significant supports to look out for below. The first is the obvious long moving average. That's currently at 23.76. The second is the neckline of the March to May 2023 head and shoulders top, currently at 23.39. The third is the bright red lower time, currently at 22.26 of the December 23 to July 24 bullish shift pitchfork, which is currently coincidental with the important neckline, currently at 22.25 of the June to July 2023 reverse head and shoulders continuation pattern. In between these last two, we have the purple lower time, currently at 22.80 for the same move as the bright red bullish shift pitchfork, but as yet it's untested, and the newly drawn middle time, currently at 22.66 of the May to August bearish, yes, first bearish Andrews pitchfork for a while. Neither of these last two have any pedigree, so I'm keeping a wary eye on them just in case they fail to perform. LME 3-month lead. I said here 24 weeks ago, and I quote, "I suspect the key overhead resistance will be the same as in late January, the congestion between 2182 to 2189. End of quote. Please remember the 2182 to 2189 level has become relevant again. So in late May, the market broke out of its previous bullish pattern and created a horn top that was the high point of the recent move upwards. Moving into June now, and we saw prices fall, reaching the primary and secondary targets for the horn top. The market continued to drive lower, down through the wide band of congestion originating from April, between roughly 2135 to 2186. A congestion area that is now overhead, and one which we're edging towards last week. This area has the gold long moving average, currently 2129, and the 50% Fibonacci line, the March 2020 to March 22 move at 2135. Further up, we have the medium moving average, currently at 2164, and another resistance band between 2213 to 2225. This one being tested and even breached for a while in early July before we hit the next overhead band, congestion between 2160 to 2225. This overhead congestion band is made up from specific levels 2186 to 2190 and 2216 to 2225, consisting of the lower trendline extension, currently 2217, the May to June 2021 descending triangle, and the 50% Fibonacci line for the whole of the 2022 move at 2225. I said about the overhead band last week, and I quote, "I have to say right now this looks a formidable piece of overhead congestion, but there is one feature developed over late July to late August that might help at least pierce it. You see, we have over this time formed a possible reverse head and shoulders pattern. It is far from a pretty one, and I'm loath to even mention it, but it does exist. And last week prices broke up over the bright red neckline, which is currently at 2024. This break higher gives us a primary target X in the 2139 area and a secondary harder to reach target X1 up in the 2177 area. Target X is close to being reached, though it is right at the start of the 2135 to 2186 congestion area," and that's the end of the quote. Well, the overhead resistances have proved to be too much in the immediate term for this market, and we ended up dropping back down to the neckline of the reverse head and shoulders pattern last week. Have gone roughly sideways to lower since. I suspect that while I may still for now have target X and target X1 overhead, I suspect we may see prices slide along the top side of the bright red neckline, as it is the easier option despite constructing a bullish looking pattern. It may indeed happen that the reverse head and shoulders pattern, which is usually seen as a bullish reversal of pattern, becomes instead the rarer bearish continuation pattern. It's too early to say if this is true as yet, but it is worth noting and considering for the future. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.